Welcome back to the Crypto Intellect, the channel where we cut through the noise, follow the money, and uncover the deeper trends shaping the future of digital finance. Today's headline is one that might sound dramatic at first, but once you see the pieces laid out together, you may realize it is actually understated. XRP news. Today. 99% of holders still don't see what's already started. Most investors are still watching charts, waiting for a breakout candle, tracking social media sentiment, and reacting to headlines. But while attention remains fixed on daily price action, something much larger appears to be developing beneath the surface. Across the globe, governments, banks, payment providers, and financial institutions are actively building the infrastructure for a new era of value transfer. The surprising part is that many of these developments are addressing the exact problems XRP was originally designed to solve. This is not financial advice, and you should always do your own research before making any investment decisions. But if you have been wondering why so many institutions continue focusing on cross-border payment innovation, while retail traders focus almost entirely on price, then stay with me because today we are connecting dots that most people still have not connected. One of the biggest stories making headlines recently involves China and its ongoing approach toward cryptocurrency regulation. Every few years, a familiar pattern seems to emerge. A restriction is announced, media outlets rush to publish alarming headlines, investors react emotionally, and markets become uncertain. Yet when we step back and examine what is happening behind the scenes, a more complex picture starts to appear. China continues exploring digital payment infrastructure while participating in broader international initiatives focused on faster and more efficient settlement systems. At the same time, the BRICS alliance is moving forward with payment modernization efforts designed to reduce inefficiencies in traditional cross-border transactions. This matters because the problem these systems are trying to solve is the exact same problem that Ripple identified years ago. Moving money between countries remains slow, expensive, and dependent on layers of intermediaries. Whether these new systems ultimately use XRP directly, indirectly, or simply validate the need for similar infrastructure remains an open question. What is not open for debate is that demand for better global settlement technology continues to increase. That demand is real, measurable, and growing in many of the regions where Ripple has spent years building relationships and payment corridors. That is where the conversation begins to shift from speculation to utility. Most cryptocurrency discussions revolve around price targets, market cycles, and short-term predictions. Those topics attract attention because they are easy to understand. But XRP was never designed primarily as a speculative asset. Its intended role was much larger. The technology was created to function as a bridge between different currencies and financial systems. Instead of replacing national currencies, the objective was to connect them. Imagine a world where value moves as easily as information moves across the internet. A payment initiated in one country could settle in another within seconds rather than days. Businesses would not need to lock up massive amounts of capital in pre-funded accounts around the world. Financial institutions could reduce operational costs while improving efficiency. This vision has always been at the core of XRP's value proposition. Yet many holders continue evaluating XRP through the same lens used for meme coins or highly speculative digital assets. They focus on the chart but overlook the infrastructure. They watch volatility but ignore adoption. They follow sentiment while missing the systems being built underneath the market. To understand why this matters, we need to talk about how global payments currently work. Traditional international transfers often rely on correspondent banking networks. Multiple intermediaries can be involved before funds reach their destination. Each participant introduces additional costs, delays, and operational complexity. In many cases, transactions can take several days to settle. Businesses conducting international trade face these inefficiencies every single day. XRP was designed as an alternative approach. Instead of routing value through a chain of intermediaries, the asset can function as a bridge between currencies. A sending institution converts local currency into XRP, value moves across the network in seconds, and the receiving institution converts the XRP into the destination currency. The process eliminates many of the traditional frictions associated with cross-border payments. Whether adoption ultimately reaches the scale, supporters' envision remains to be seen, but the problem XRP addresses is unquestionably real. Global commerce continues expanding while existing payment systems struggle to keep pace with the speed demanded by modern markets. That challenge is not disappearing. In fact, it appears to be becoming more significant as international trade and digital finance continue evolving. Now here's where many investors miss an important point. There is a common assumption that lower prices somehow make an asset more useful, But when discussing settlement infrastructure, the relationship becomes more complicated. Ripple executives, including CTO David Schwartz, have explained that extremely low asset prices can actually create inefficiencies for large-scale settlement systems. Think about the mechanics involved. If trillions of dollars in value need to move across a network, sufficient liquidity must exist to support those transactions. When the value of the bridge asset is low, larger quantities are required to settle the same amount of economic activity. That can increase friction and create challenges related to liquidity depth. As the value of the asset rises, larger transactions can be supported with fewer units. This is not necessarily a prediction about future price performance. Rather, it is a discussion about how liquidity functions within a settlement framework. The key takeaway is that XRP's utility model differs significantly from many digital assets that rely primarily on speculation. If widespread adoption ever occurs, the economics of the system become closely linked to the scale of activity flowing through the network. Another major development receiving less attention than it deserves involves the rapid expansion of stablecoins. Around the world, governments, fintech companies, and financial institutions are exploring digital representations of fiat currencies. We are already seeing dollar-backed stablecoins, euro-backed stablecoins, and discussions around digital versions of numerous national currencies. At first glance, some people assume this trend competes with XRP, but there is another perspective worth considering. If every country eventually launches some form of digital currency or regulated stablecoin, interoperability becomes a critical challenge. A digital euro cannot automatically transform itself into a digital yen. A company in Europe paying a supplier in Asia still requires an efficient mechanism to bridge those currencies. This is where supporters argue XRP's role becomes increasingly relevant. The more digital currencies that exist, the more important interoperability becomes. Every new stablecoin added to the ecosystem creates another connection point that must interact with other currencies. Rather than reducing the need for bridge assets, a multi-currency digital world could increase the importance of neutral settlement mechanisms capable of connecting fragmented financial systems. This broader shift toward tokenized value is one of the reasons many long-term XRP holders believe something significant has already started. They are not necessarily focused on what happened this week or this month. Instead, they are watching the gradual transformation of financial infrastructure. Tokenization discussions are taking place among major banks. Central banks are studying digital currency frameworks. Financial institutions are experimenting with blockchain-based settlement systems. Governments are evaluating regulatory approaches. The important thing to understand is that infrastructure changes happen slowly at first. Major transitions rarely arrive overnight. Instead, years of development occur before the public fully notices what has been built. By the time the average observer recognizes the trend, much of the foundational work has already been completed. This is why some investors argue that waiting for obvious confirmation may mean arriving late to the opportunity. Whether that perspective ultimately proves correct remains uncertain, but it highlights the difference between watching headlines and watching infrastructure. One focuses on short-term narratives, the other focuses on long-term transformation. Another area attracting increasing attention is the evolution of the XRP ledger itself. Ripple has outlined a roadmap centered around expanding functionality and improving features designed to support institutional participation. Among the most discussed initiatives are privacy-focused capabilities that could help address concerns financial institutions have regarding public transaction visibility. Banks and large organizations operate under strict legal, regulatory, and commercial requirements. They cannot simply expose sensitive transaction details to the entire world. This reality has created challenges for many public blockchain networks seeking institutional adoption. According to Ripple leadership, privacy enhancements represent a major step toward making blockchain-based settlement more attractive for enterprise use cases. The significance of this development is often overlooked because technical upgrades rarely generate the same excitement as dramatic price movements. Yet infrastructure improvements can have long-term implications that far exceed the impact of short-term market volatility. If institutions gain the tools they need to operate comfortably within blockchain environments, adoption pathways could become significantly broader than they are today. When examining institutional participation, it is important to recognize the distinction between capability and implementation. Many blockchain networks already possess impressive technical capabilities. Speed, scalability, and cost efficiency have improved dramatically across the industry. Yet technical capability alone does not guarantee adoption. Institutions require regulatory clarity, compliance frameworks, operational reliability, and privacy protections before committing significant resources. This is where many observers believe the next phase of development is occurring. Rather than focusing solely on technological innovation, companies are working to bridge the gap between blockchain systems and real-world financial requirements. The conversation is shifting from what is technically possible to what is institutionally practical. XRP's supporters argue that this transition aligns closely with Ripple's long-term strategy. Whether discussing payment corridors, enterprise partnerships, stablecoin integration, or ledger enhancements, much of the focus appears centered on making blockchain technology usable within existing financial systems, rather than attempting to replace them outright. The emergence of RLUSD has added another layer to this evolving story. Ripple's stablecoin initiative represents more than simply launching another digital dollar. Supporters view it as part of a broader ecosystem strategy designed to strengthen network utility and expand participation. Stablecoins continue attracting significant attention because they combine blockchain efficiency with fiat currency stability. Businesses often prefer predictable value when conducting transactions, making stablecoins particularly attractive for settlement purposes. As RLUSD expands into additional markets and use cases, some analysts believe it could contribute to increased activity across XRP ledger infrastructure. What makes this interesting is the potential interaction between stablecoins and bridge assets. Rather than existing in competition, they may fulfill complementary roles within a larger financial ecosystem. Stablecoins can provide stability and familiarity, while bridge assets facilitate interoperability between different currencies and networks. If that model gains traction, the growth of one component could indirectly support demand for the other. Many investors still underestimate the importance of network effects in financial systems. Infrastructure becomes more valuable as participation increases. Every new institution, exchange, payment provider, or market connected to a network expands its potential utility. This process often appears slow until a tipping point is reached. Then growth accelerates rapidly because each new participant benefits from connections already established by previous participants. The internet itself followed a similar pattern. Early adoption seemed limited and uncertain. Over time, however, network effects transformed it into one of the most valuable systems ever created. Supporters of XRP believe a comparable dynamic could eventually emerge within global payments. They point to expanding partnerships, developing corridors, increasing regulatory engagement, and growing institutional awareness as evidence that foundational layers are steadily being constructed. Whether those developments ultimately translate into the outcomes investors expect remains uncertain, but the network effect argument explains why some holders remain focused on adoption metrics rather than daily price fluctuations. There is also an important conversation happening around leverage and risk management within the XRP community. As excitement grows regarding potential future adoption, some investors consider borrowing against their holdings or using XRP as collateral. While these strategies may appear attractive, they introduce significant risks. Cryptocurrency markets remain volatile, and even assets with strong long-term narratives can experience sharp short-term declines. A position built over years can be threatened by a temporary market downturn if leverage is involved. This is why many experienced investors emphasize caution during periods when utility-driven demand has not yet fully materialized. Market sentiment continues playing a major role in price discovery. Sudden shifts in macroeconomic conditions, regulation, or investor psychology can create substantial volatility. The lesson here is simple: conviction should never replace risk management. Regardless of how promising an opportunity may appear, protecting capital remains essential. Long-term success often depends as much on surviving volatility as it does on identifying opportunities. Chart comparisons have also become increasingly popular as traders attempt to determine whether XRP is repeating patterns from previous cycles. Side-by-side comparisons between current market structures and historical rallies circulate constantly across social media. While these patterns can provide useful context, they should be approached carefully. Markets are influenced by countless variables, many of which change over time. Similar structures do not guarantee identical outcomes. What makes the current environment particularly interesting is the presence of infrastructure that did not exist during previous cycles. Regulatory discussions have matured. Institutional involvement has expanded. Stablecoin ecosystems have grown dramatically. Blockchain adoption among traditional financial players has advanced considerably. These differences matter because they alter the underlying conditions driving market behavior. Historical patterns can offer insights, but infrastructure often determines long-term outcomes. Understanding that distinction helps explain why some investors pay more attention to adoption trends than chart formations. When we connect all these developments together, a larger picture begins to emerge. Global payment systems are evolving, stablecoins are expanding, financial institutions are exploring tokenization. Cross-border settlement remains a major challenge requiring better solutions. Regulatory frameworks continue developing. Blockchain infrastructure is becoming more sophisticated. Privacy enhancements are being introduced. Enterprise participation is increasing. None of these developments guarantee success for XRP, but they collectively illustrate why some observers believe the story is much bigger than price action alone. The argument is not that a single announcement will suddenly change everything. The argument is that numerous independent trends are gradually converging around the same set of problems. When multiple industries begin searching for solutions to identical challenges, technologies specifically designed to address those challenges naturally attract greater attention. This is precisely why the headline today matters. 99% of holders may still be focused on what has not happened yet. They are waiting for the explosive move, the major announcement, the dramatic confirmation event. But according to many long-term observers, the more important question is whether the process has already begun. Infrastructure does not appear overnight. It is designed, tested, regulated, integrated, and deployed over years. By the time it becomes obvious, much of the value creation phase may already be behind us. That does not mean success is guaranteed. It means understanding where attention should be directed. Instead of asking only when price will react, some investors are asking whether the foundations supporting future adoption are already being constructed. If they are correct, then the most important developments may be occurring far away from the daily charts dominating social media discussions. As we wrap up today's analysis, remember that markets often reward those who identify structural changes before they become mainstream narratives. China's payment initiatives, BRICS settlement discussions, stablecoin expansion, XRP ledger upgrades, institutional privacy solutions, growing enterprise engagement, and evolving regulatory frameworks are all pieces of a much larger puzzle. Individually, each story may seem insignificant. Together, they form a narrative suggesting that global finance is entering a period of transformation. Whether XRP ultimately becomes a central component of that transformation remains to be seen. But one thing is becoming increasingly clear. The conversation is no longer just about cryptocurrency. It is about infrastructure, interoperability, and the future movement of value across the global economy. If this analysis helped you see the bigger picture, make sure to like the video, subscribe to the Crypto Intellect, and share this discussion with someone who is still focused only on headlines and price charts. Stay informed, stay prepared, and as always, I will see you in the next one.